Hi everyone, this is Malika, the author of How the Best Invest Make Confident Decisions Like the Investing Superstars. And today I wanted to talk to you about initial public offerings, IPOs, where formerly private companies whose shares are held only by their corporate executives and the venture capitalists who invest in them take their money to the public markets and list themselves so that private investors, individual investors like you and me, can buy shares. And hopefully the company can make a huge amount of money doing that. So the story actually starts with us individual investors. Like, individual investors often feel left out of these big news events, but we're actually at the core of the story, because an IPO really starts with your office worker or your typical average fireman or your typical average professor who takes a few $100s of his or her pension every month and puts it into their pension pot. And over the years and over thousands of employees, these pension pots become quite large and they need to deploy capital and make returns so that they can pay for your retirement. So they look around and they say, hey, startups might be a good place to make quite a lot of money. And so they start looking around at startups to invest in. And the best way, most efficient way for them to do that, they found, is through venture capitalists. Venture capitalists are people who have a big book, a deal book of, they know lots of entrepreneurs, lot of startups. They've probably been entrepreneurs previously. And they have the connections into the pension funds, and they raise these sort of $100 million to $1 billion funds, and they lock up the money for 10 years or so, and they earn about 2% a year management fees, which is quite healthy, and a 20% performance fee if they do well. And they take the money from the pension funds and start to deploy it in these startups. The startup entrepreneur, the startup founder goes, okay, I want to take this idea to market. I want to build this product or service. I need capital to do that. So they go to the venture capitalists and they start to get drips of money to try and build this. So it could be angel investing first from friends and family, and then Series A, Series B, and so on, tranches of money as they build their goods and services. Now, if they get lucky, and very, very few people actually manage to do this, they will get sales, and then they will have enough traction in the market that they want to go to IPO. And the venture capitalists want to make their return because they all have little shares, and the corporate executives of the startup want to make returns because they all have their shares. And to get that big payout, they typically want to go to the public markets. Now it's changed a little bit, but they go out and again they sell back to the pension funds and the retail and individual investors who might buy their shares again at this higher price. So that is the life cycle of the IPO. And right now, as we see, Uber IPO'd, Palantir IPO'd, the investment bankers Palantir is trying to IPO. The investment banks get involved in marketing the IPOs at the right price so that people, their valuation is all in the mind. And so they try and price it so that people get a nice pop on the first day so they feel very good that their share suddenly went up. And there's a whole ecosystem that does this, and it's quite fascinating to watch, and it's evolving as the markets become a little bit more difficult. And I think one of the things I would like you to take away from this video is you are part of that process. Like, even if you have just a small pension fund, a pension pot, your money is probably going to work in these startups. Thanks so much.